By the time I was 25, I had 2 foreclosures and $300 in cash. I went from owning 2 properties and thinking I was amazing to sub 500 credit score in 6 months.
I would have been traumatized by this whole experience. What's one piece of advice you wish every home buyer knew before signing that dotted line? And I approve this message. Hello and welcome to StreetSmarts MBA, the podcast where we teach you how to be an adult. Today we're diving into one of the most confusing, expensive, and misunderstood parts of adulthood: mortgages. Most people sign the biggest financial contract of their life without fully understanding what they're committing to. Our guest today is Joshua Brenner, a seasoned mortgage broker with FM Home Loans, with close to 10 years of experience helping buyers avoid disasters and save money. We're going to bust myths and share inside tips, so let's get into it.
Let's.
Josh, it's so good to see you. I met Josh decades ago.
Yeah, when we were slightly less young.
And Josh has always been financially savvy and very disciplined. And I would love for you to tell the audience a little bit about yourself and your background and how you got into mortgages.
That's a great question. I wish I was always savvy. I wish I was always disciplined, like you said. But it's, like anything else, it's a journey. So right out of high school, I joined the United States Navy. And I quickly realized that I love serving, I love being in the Navy, but you live on the ship, and for probably about 1% of Americans, they don't really, they know what I'm talking about, but imagine living under your desk at work. It wasn't working for me. So luckily, I was in Norfolk, Virginia, and it was a time and a place where on my Navy salary, I could take the VA home loan and go out and buy a house, and that's what my first experience was. My poor real estate broker, we probably put in an offer on, it had to have been close to 13 properties. I made no money. I didn't know that I should have a down payment. I was like, oh, the VA is going to take care of me. I ultimately got the house, and I got into this crazy product that I didn't know anything about. And I asked all the wrong questions, and I never met my mortgage banker or broker. And fast forward a couple years, it was the height of the Great Recession. And by that time, I thought I knew stuff. I thought it was so smart. That property in Virginia when I first bought was a rental property. I was big stuff. I was making $122 a month between, the difference between my mortgage and my rent. And I moved out west and I bought another place and I was renting out the spare room, right, making $600 a month. I was making $700 a month as a real estate tycoon. And and in monopoly money, that's great. But in reality, it was all very much a shell game because I did not avoid disaster. By the time I was 25 years old, I had a knock on the door, and it was the sheriff coming to kick me out of my property because I had foreclosed. I thought I had put the paperwork in, and the recession happened, and I lost my job, and I foreclosed on this property, and that caused what's called universal default, and lost the other property back in Virginia. And by the time I was 25, I had 2 foreclosures and $300 in cash to drive my sad self from Denver, Colorado, where we met. And lovely, lovely place, by the way. Drive myself back to my mommy's house, at 25 years old with $300. So that was my first iteration and attempt at being in the mortgage world and owning real estate and trying to be what I thought I should be. It was later after I went to college, I got into investment banking and then ultimately got into real estate investment banking where I was working on very large projects, brokering mortgages. I was finding multi-million dollar transactions and then finding banks and other investors to help purchase this transaction and finance the property. And then at a very high level was doing the same thing that I'm doing today. The only difference is now I help normal homeowners or mom and pop investors. That's been my experience since out of college. I was like I said, I was in the military, so I was in college later in life. So I graduated right around 2016, been in real estate basically ever since professionally. I've always been in real estate. It's where I live. It's where most of us live. And so, it's been my journey to go from the consumer of products and be on that path of extreme confusion. And I try to channel that in every transaction. Because there is so much jargon in this industry and many financial industries, so much jargon, a lot of it meaning the same thing. I try to channel that 20-year-old confused kid just used to signing everything because he was in the military. Don't do that, by the way. Join the military, but don't just sign everything. So I try to channel that and try to remember as best I can that most people only buy 1 or 2 houses. The average length of a mortgage is about 7 years. So whether you're buying and then in 7 years you restructure or refinance your loan, you only do it like 2 or 3 times in your lifetime. So how could you remember? And things change, by the way, from the last time that you did it and the last guy or the last person who helped you. So everything's different always, and it's not your job to remember. So it's my value proposition to guide those people through the black box of mortgage and mortgage regulation. So in a nutshell, that's been my story.
Wow, that's quite a turnaround.
Sure.
I would have been traumatized by this whole experience.
Oh, I was sad for a really long time. Yeah,
Wow.
I was, it really forced me, that whole 25-year-old Josh, really forced me to realize, number one, what's important, what's in it, what isn't important. And that was 16 years ago. And look, we all have a relationship with money. It's a tool at the end of the day, but now I just have some very strong preferences, and I take far less risk. There's a lot of benefit to what I did. The execution wasn't totally there. It's good to take risks. If you're going to go broke before 30 because you have time to rebuild. But yeah, I went from owning 2 properties and thinking I was amazing to a sub 500 credit score in 6 months. But I did get, and this is the important thing, I did get a $2,000 check from the massive lawsuit. So it worked out in the end, right? I had my life was completely ruined for 8 years, but I got $2,000 out of it.
Can I ask you?
Sure.
Did you get any assistance from someone from the military?
So that's a good question. So the way a VA loan works is that if you're a veteran, and I think it's 181 days of service in the military, you just are, and there's active duty and reservists, and there's some nuance there. But the only major criterion is that you have served in the military to become a veteran, and that you as the veteran are living in the property. Mm-hmm. So the guidance from the military, it's not the military responsibility to make sure I pay my bills.
Yeah.
They pay me a paycheck, or they paid me a paycheck, and I put on my big boy pants and decided to take on this loan. And it was fine. It was great. The entire time I was in the military, it wasn't a problem. It was only after I got out of the military, I moved 2,000 miles away, thought I could manage one single family property as a 23-year-old kid 2 time zones away. But that's where things get hairy, and this is probably time for another conversation, but don't do that.
Why is this whole process so confusing for most people? And what actually happens when you sign a mortgage that you don't understand?
Sure. Why is it confusing? It's a lengthy process. There's a million steps that, because I do them every day, and I'm on a call every week, 2, 3, 4 people explaining the process. I know it inside and out, so it's very simple to me. But again, the average length of a mortgage in the United States is about 7 years. So people either sell, move, refinance, whatever. So people are doing it once a decade, and maybe they're doing it 2, maybe 3 times in their life. Three would be a high end. So simply put, it's a lot of steps. People don't do it that often. It's not talked about, and there's just a lot of lore, and even in today's modern age of the information age, people mostly are talking in sound bites, not nuance. There's a lot of personal opinion. So there's just so much information that it can become confusing, and the information that's out there does carry a lot of jargon, so it can be overwhelming.
So you've kind of touched on what happens when someone signs a mortgage that they don't fully understand. You described that with your own story. But what are the biggest regrets homeowners have after signing?
that they had to pay it back, right? I'll tell you, I can't speak to how other people do business, and I don't trash competition. I don't know how other people do things. I'll just say from my perspective that, I do my very best, and I think the system is better now. When I was buying my first properties, it was before Dodd-Frank, which is a big piece of legislation after the Great Recession that came into play. The mortgage industry was much more of a wild, wild west. Now things are a little bit more systematic. There's something called a loan estimate. So basically from day one, you have expectations of what your payment will be. I'll say the biggest regrets around a home purchase come from just a lack of communication and a misunderstanding and a misalignment of expectations. So maybe a borrower thinks they're going to get a certain rate or fee structure and they don't ultimately get it because whatever happened, the market changes, rates go up and down every day. They didn't lock in, they didn't communicate, just miscommunication and a misalignment of expectations from all aspects creates resentment. So what I do in my own practice is that I talk to everyone involved, at least on a weekly basis. And when I talk to the borrower, again, they're busy living their lives, I say, hey, this is where we are. This is what we're doing right now. This is our next step. This is what you can expect. And by the way, we're going to get ready to close on this day. And I find that, it wasn't always this way. I was a mess the first, handful of years. I didn't know why people were angry at me all the time. And I really started, I was like, go figure. It's like the biggest purchase of your life. You don't hear from the guy and now you're mad. Go figure. So it's really about communication, just like everything else. And setting expectations to be real. And there's a lot of fear, there's a lot of anxiety, and you really do, just like any other profession where you're in finance, you're dealing with someone's finances, whether it's a financial advisor or, I'm not a doctor, but like a doctor, you're dealing with high emotions. But it's getting those people off the cliff and saying, hey, is this real or is this reality? Or is this your emotions getting the better of you? Like, let's talk about this and unpack it. So there's plenty of conversations I have as the mortgage banker, and it's really just about feelings.
And I'm guessing a lot of people don't understand everything, so it's on you to explain it so there are no surprises later on.
No surprises.
For them, yeah.
No surprises. And you know what? There's so many steps to the process. We're all human. People make mistakes. So if something's forgotten, just own it, apologize, move on, and fix the situation. People don't really hold a grudge. If it's fixed, everything, all's well that ends well. Just fix it. We're all people at the end of the day.
Thank you. Now let's break down the different types of mortgages.
Sure.
Because what you choose can either save your money or set you up for another disaster.
Sure.
So let's decode the options. Should we start with reverse mortgage?
We could. It's a very easy subject. It's a very specific loan. It's only for people who are 62 years or older. And what is it? It's just like it sounds. A regular mortgage is technically called a forward mortgage. So going forward, we pay for the loan to be paid off. Reverse mortgage is the opposite. So we already own the asset, and the asset then pays us. So it's a very specific niche product. You'll see it advertised on daytime TV with gentlemen with great mustaches. But at the end of the day, it's the vast, vast, vast minority of mortgage holders in the United States have a reverse mortgage. Very uncommon. I've done some. They're great for who they're great for, but it's not a common product.
So let's say you have a young couple who are on the market to buy a home. What would be the most appropriate mortgage for them?
Great. That's the $1 million question, right? So everything in the mortgage business is bespoke. It's unique. Every property is unique. Every borrower is unique. So the general terms of a first-time home buyer program, in reality, Yaffa, there's no such thing as a first-time home buyer program. That's
really?
It's kind of like marketing. Yeah. And most people, when they say first-time home buyer, they immediately think of FHA or Federal Housing Authority, which is a loan program backed in part by the federal government. It's a great program for people who need a little bit of wiggle room. Maybe they have too much student loan debt. I'm thinking of typical borrowers. Someone younger, they probably have a little bit of student loan debt. They probably have some credit card debt. If they're in the outer boroughs or Westchester or Rockland, they probably have a car payment. Just people living lives. So when you go to make a purchase of a home, you have to compare your total income to your total debt, and you have to hit a certain ratio. It's called a debt to income ratio. So when you look at an FHA program, a Federal Housing Authority program, that debt to income ratio is higher than some conventional programs. So if you carry a little bit more debt, for whatever reason, you can still qualify for a home loan. The benefit of FHA is a discounted interest rate, so you actually save a little bit of money when it's a relatively low down payment. If you're buying like a single family house, FHA is about 3.5%. Now, if you're in the great city of New York, if you're buying a condo or co-op, the condo or co-op building and board, they dictate the minimum down payment. So it's exogenous. It's outside of my control as a mortgage professional to determine what the down payment is. So in the case of what you're describing, we have to check the person's income, their assets, and their credit, and then we talk to them what's most important to you. And these are our minimum down payment programs. Conventional loans are 3% down payment, so it's a little bit less than an FHA. So it really depends on what's best for the borrower. So for people to think, I have to put 20% down, and real estate in New York State or New York City is so expensive, I'm never going to get there. You don't have to put down 20%, you can put down less. There's a little bit of a restructuring of the loan. A single family home in Queens or Brooklyn or even the Bronx and Staten Island, the outer boroughs, you can get those single family homes, do 3%, 3.5%, 5% down. You don't have to do the 20% down payment. So what's best for that couple really depends on their income, their assets, their credit, and how much they're able to carry on a monthly basis.
You mentioned debt. You said if you have a little debt. What's a little debt? Does student debt play a part in what you would qualify for? Unfortunately,
it does. Yeah. So it's kind of a bummer. This is a whole different podcast with student loans, but let's do the couple scenario. There's two people. They both make median income of New York City, which is $65,000 a year. So let's say, for argument's sake, they make $130,000 a year, which is a little over $10,000. It's $11,000 and change a month. So let's use $11,000 to qualify for a loan. And again, this is going to be a house, not a condo or a co-op. Out of that $11,000, let's say we're going to go with an FHA program, which allows more debt. You want to have 50 cents on the dollar or less going towards debt. So if you make $11,000, $5,500 a month or less can be going to your debt payments, all debt payments. So that means your entire mortgage, and your mortgage is broken up into 4 parts: principal, interest, taxes, and insurance. So the principal and interest is what you pay the bank. Taxes is what you pay the city or the county or the state, all 3. And then the insurance is for catastrophic replacement, right? So that's your mortgage payment is principal, interest, taxes, insurance. So out of that $5,500, the $5,500 a month in our scenario has to cover your full mortgage payment and your student loan payment and your car payment and your minimum credit cards and whatever else. So the crunch that millennials, Gen Z is feeling is like, okay, I'm coming out of school or I'm starting in my career. I'm in like the early to mid part of my career and I'm hitting a stride and I'm ready to buy that house and I've got the down payment and I can cover closing costs. But man, oh man, the decision I made when I was 18 to go to that school is coming back on me. Hopefully at 35, it's less serious than it is at 29. But, if you look at the numbers, or when our parents were our age, they had been in a house for 10 years, 15 years. But now the average homeowner is late 30s, even early 40s for that serious issue.
Wow. Thank you for that tidbit. Can you talk about ARM versus fixed?
Sure. So let's talk about what is a fixed rate and what is an ARM. An ARM is adjustable rate mortgage, ARM. Most countries globally, by the way, they don't have a fixed rate option. Yeah. I was doing a transaction with a lady who was moving from Australia to New York City. We got one. And she was like, what do you mean I can lock in my rate for 30 years? I've never heard of such a thing. And I did a little research. Most countries, adjustable rates are the only way to go. So there's something called an amortization schedule. So you take your full mortgage amount, add in your interest, and you divide it over 360 payments, which is 30 years. That gives you your amortization schedule. Fixed mortgages have the same payment on the first payment as it is on the 360th. So in 30 years, your principal and interest payment will never change unless you refinance or restructure the loan. Adjustable rates have that same amortization schedule. You're paying back the loan in 360 payments, but for the first 3 years or 5 years or 7 years or 10 years, so let's say a 10-year adjustable, your first 120 payments are at the interest rate that's advertised. So let's say today, rates are around 6.5% for a 30-year fixed. For a 10-year adjustable, you might be able to get 6%, 6.125 or 6 1/8. So for 120 payments, you're going to be at 6 1/8% interest versus 6.5. So you do save some money in the short term, but you're banking on the fact that rates will go down within the next 10 years. If rates go up, you face that interest rate risk, and you either have to refinance at a higher rate, or you can take a little bit more risk and let your rate adjust up for a year, and then every year it'll adjust. Now, are adjustable rate mortgages bad? No. They're a tool just like anything else. So if you're saying, I'm going to be in this house or I'm going to be in this property for 30 years, I never want to worry about anything changing, and if and when rates go down, I'll take advantage of that, then an adjustable rate mortgage is not for you. If you were like me when I was younger, and I'm only going to be in this house for 3 years, then an adjustable rate mortgage is perfect. And I was only in that house for 2 years. It was only when I decided it was a great idea to rent it that the adjustable rate became a problem. Now, what's the middle ground? You want to save a little bit of money. You want to be in your house long term. So really, the 7-year adjustable or the 10-year adjustable makes sense. Because again, most people change their living status or mortgage every 7 years. So the average age, again, of a mortgage, 7 years. 7-year adjustable, 10-year adjustable makes sense. And you've paid off your principal. So even if you have to adjust at a higher rate, you refinance at a higher rate, you've paid off a third of your loan after 10 years. You're paying a higher interest rate, but you have a lower principal. You can still save money on your monthly payment, which is the thing that people care about the most.
Ooh, okay. Should we talk about balloon mortgages and who
Sure.
are they marketed to? And
That's a really quick
who
answer.
should run from them?
Everybody. No, so balloon mortgages are typically more of a commercial product. So let's say you want to buy something quickly. It's an investment property or an apartment building or whatever else. You're not going to live there. It's not your primary residence. You're going to have a balloon product. Mostly in New York State and the surrounding states, New York, New Jersey, Connecticut, most states have similar laws that are consumer protection that disallow balloon mortgages in a consumer setting because they're risky, right? Like you have 9 months, 12 months, 18 months, whatever period that's fixed, and then all of a sudden you owe this huge sum of money at the end of the term. Well, we can't have people being kicked out on the streets by the banks. So balloons are typically reserved for commercial mortgages.
Okay. The next one is interest only versus principal plus
Sure.
interest and the real cost of low monthly payments.
This is I love this. So interest only, again, like there is a tool for every job. Interest only, man, you're not risk averse, right? You're the kind of person who says, I'll worry about it later, or I'm going to make more money. Maybe you've got a big bonus coming. Maybe you're in a really inconsistent income kind of industry, entertainment, sports. You're not working the 9 to 6, punching the clock union job, which I love those guys. They're great guys. But maybe you're a founder and your next paycheck is 18 months out when you sell the company. So just like a risk averse, it's a risky loan. So the banks, what they do is they'll give you the same 360-month amortization, and usually it's 10 years. The first 10 years are interest only. And what does that mean? Exactly what it sounds like. You're only paying the interest. So what's happening? You owe the same amount on your home in 120 months in 10 years that you did on day one.
Oh, wow.
Let's say you bought a house on day one for, let's say, $750. You owe the same amount on day one as you do in year 10, and you've only paid the interest. What's the strategy here? You're probably saving $300 to $500 a month. Because you're not paying principal, right? Amortization means that you're paying principal and interest together in a mix. And usually around year 15 is where the interest is less and the principal is more, okay? So someone who does an interest-only loan, they're extremely savvy or they're extremely willing to take risk. Again, not typical. Your interest rate's actually a little higher than you would do if you did a conventional loan or a fixed interest rate loan or even an adjustable rate. But because you're not paying principal, you still do keep money in your pocket. It's just, you got to be so careful with it. Again, it's one of these things where if you get a big bonus or you have a big sale or, some sort of big amount of money coming in the future and you say, okay, I'm going to take a good portion of this, I'm going to pay off some of the principal of my loan instead of $750, I'm going to, throw a bunch of money at it. Then an interest-only loan that's your best practice. But to say, I had a client years ago. They were in the high-end market of Los Angeles, and they never paid any money towards their principal. They just only ever had 10-year interest-only loans, and I just didn't understand. I was like, you make great income. I'm like, why are you never paying off your mortgage? Right? The ultimate goal. Who wants debt forever? They were relying on the fact that the LA market was always going to go up and that they would build equity in their property simply because values go up over time. That's a strategy. Sure. But for them, it worked. And the numbers worked out. And it's not something that I would do. It's not something I would do now. But you know what? It's kind of perfect because they weren't emotional about the real estate. Yeah, they lived there. Yeah, they loved it. But everything is temporary to them, and they'll move to another place. They'll scale down. They'll scale up. They'll do what they have to do. So it's a very specific product. Again, the person who's buying their first home, they're making typical income. It's not a product that I would encourage. And again, I don't get paid on product. I don't get paid on interest rate. Frankly, I wish interest rates were capped at like 1.5%, right? Like, why bother? My goal is to get you into the thing that fits your personality because personal finance is more personal than finance.
Wow. So when people come to you, you discuss all of these options?
100%.
And you advise what would be the best choice for them. Is that correct?
So just like a therapist doesn't give you advice, and they only ask questions and they let you resolve it.
Got it.
I ask questions like, what's more important to you? Is security more important to you? Or do you want to save the absolute most amount of money you can? Like, tell me some of the things that are most important to you. Everyone always wants the lowest rate. Everyone always wants the smallest payment. Everyone wants to save the most amount of money, rather. So it really comes down to, like, are you going to be comfortable in 5, 6, 7, 8, 9 years? The risk of what will be in the future, are you comfortable with that risk or are you not comfortable with that risk?
So what would you say is the common mistake that people make when choosing a mortgage for themselves?
I think it's just not talking about these things. If you're buying a property with another person, you need to have that conversation and really find out what's important to your partner in that purchase. Like, what's most important about money to them? And how do they view money? If I had purchased a property with a person in my 20s, that would have been a much more risky loan than if I'm doing it in my 30s, 40s, or even when I get to my 50s. So, what's most important to the people involved in the transaction? Doesn't matter to me. I will say, like, don't do this really risky loan. I don't think it's a good idea. 3 years is not a good enough time for an adjustable rate mortgage. You really kind of want to be bare bones minimum 5 years, but really 5, 7, maybe 10, depending on the pricing. So there are a few things that I will encourage people to stay away from. But again, it's their decision. I can only do so much. So the reality is product almost doesn't matter. So if you have a 30-year fixed and you're paying an interest rate and you have a 10-year adjustable and you're paying a slightly lower interest rate, you can still make additional payments to your 30-year fixed. You can cut off time on the back end. If you make, on average, 4 to 6 years will come off of a 30-year fixed loan if you make 13 payments instead of 12. People say, well, what about 14? Well, now it's like a lifestyle thing and you have to like choose to pay. Yeah. But I think that getting into a property for the first time, choose the thing that you can plan around the most. Look, if you're getting into a property and it's a one-bedroom apartment and you're in your late 20s, do you really anticipate being in a one-bedroom apartment for 15, 16 years? If yes, great, cool, let's do a 30-year fix. If not, let's take a little bit of risk. Let's save some money up front. But if you're saying, I want something, like a cruise liner, just easy, like right down the line, do a 30-year fixed. If you can afford as your income grows, do that 13th payment per year and cuts off probably 4 to 6 years on the back end. So you're meaning like your 30-year loan becomes a 24-year loan or a 25-year loan. You save interest on the back and you own your property sooner.
Thank you.
You're welcome.
Now let's talk timing. Rates are up. Headlines are confusing. How do you know when to buy or when to wait? And what should first-time buyers be doing right now?
Sure. First-time buyers, you want to get pre-approved. Only with me. No, but you want to get pre-approved.
And I approve this message.
So there's something called a pre-qualification. There's something called a pre-approval. Pre-qualification, you're probably familiar with this. Like you probably get stuff in the mail. You're pre-qualified for this credit card. So you get the thing in the mail, it's an ad, and then you first have to like do the application. So you're not really pre-approved for anything. You're pre-qualified because, that credit card company says, oh, Yaffa is a human being in this zip code who is alive.
You fit the criteria.
Yeah, you fit their extremely non-specific criteria. So that's what a pre-qualification is. It doesn't really doesn't hold water. Pre-approval is very much like you work with a loan officer to get pre-approved, meaning that loan officer has looked at your credit, looked at your income, looked at your assets, and said, hey, based on who you are and where you are in life right now, this is how much house you can afford. That should almost always be the first step. And then your realtor, your real estate agent, takes that pre-approval, not pre-qualification, pre-approval, and says, okay, great, let's go into the marketplace using this pre-approval to find a house that you like based on these criteria. So that's where people should start. And you want all of your surprises to happen in the pre-approval stage, meaning I want to find out all the skeletons in your credit closet, if there are any. I want to understand your pay cycle, your pay structure. I want to get all these issues evened out before we even get to under contract, so that once we're under contract, I'm ready to close in 20 days. So all the surprises happen up front, all of the meltdowns happen up front, and you don't have 10, 100, 150,000, like life savings on the line because you put up a deposit on this contract, and now all of a sudden your loan officer is like, oh, I missed that.
So the loan officer approves it.
Correct.
That does the pre-approval.
Correct.
Okay. So how long does this pre-approval last? Is there like a...
Sure. Usually they're good for 30 days.
Okay. So
yeah.
then after that, if you are still looking for a home, you have to do
Just
it again?
refresh. Yeah.
Oh, really? Okay.
Yeah. So that's actually an excellent question. Throughout the loan process, people's frustrations are usually, oh, this guy keeps asking me for more and more stuff. Well, because documents expire. These are criteria that are typical in all lending institutions. I'm sure you've heard of Freddie Mac and Fannie Mae. Okay, so those are the number one buyers of mortgage debt in the United States. So they set forth lending criteria to which most institutions underwrite. And they say, and part of those criteria are, your pay stub is only valid for this long, your bank statement's only valid. Usually it's something's only valid until the next one comes out, and then the oldest one is expired. So that's why your mortgage professional is asking you, hey, Yaffa, can you send over your pay stub again? Can you send over a new bank statement? So the longer the transaction goes, the more that you have to do that.
So every time you do that, though, they run your credit?
No. So in my practice, and again, I'm only speaking about myself, my credit report is good for 120 days, which is 4 months.
Okay.
So ideally, let's say a borrower will come and we'll do a pre-approval. We'll have a 30, 45-minute conversation about preferences and styles and what they're looking for and what works for them. And that's kind of where we settle on probably which kind of product we're going to do. And then we do the pre-approval. I get their income, their assets, their credit documentation, find out if there's any hiccups along the way. I ask as many questions as I can. And then I'll do the pre-approval. Pre-approval takes me, depending on what it is, hour, 2 hours. That pre-approval is good for about 30 days. So let's say day one, let's call it a Monday. On a Monday, we have a pre-approval. Monday afternoon, you go out, you find a house you love, you put in an offer. By Wednesday, your offer is accepted, hopefully. And in New York, you're going to have something called attorney review. Okay, your attorney as a buyer is going to talk to the seller's attorney. You're going to iron out all the details in the contract. So you're going to have that attorney reviews probably 3 to 5 days. So by the next Monday, 1 week after we've spoken, you're under contract on a house. So now your pre-approval is irrelevant because you're under contract. But all of your documents that I have from doing the pre-approval are good for the next 30 days. I probably will need a new bank statement, but your credit report is good for the next 113 days, whatever the math is there. So I'm not like checking credit. There are people who do shop. If you go and you say, I bank with this, Hometown Bank USA, and I'm going to check Hometown Bank USA, and I'm going to check, some guy online. I'm going to check this and that. You can, for the same transaction in a 45-day window, for the same purpose, you can have your credit checked multiple times, and it doesn't diminish your score.
Oh, really? Okay.
It's not supposed to. The point of credit is to use it. So your score, look, 100%, if someone checks your credit and there's a hard pull, which is an 8-year look back, if someone does a hard pull on your credit, a couple of points come off. But to be frank, after 30, 45 days, the 3 to 5, maybe 10 points that came off your credit score come right back up as long as you continue to pay your things on time and in full.
What should a first-time buyer do in a high-rate market?
In a high-rate market, again, it depends on your personality. If you can come into a fixed-rate mortgage, and even it's in higher-rate market, and you can afford that high-rate mortgage, and high-rate is really right now 6.5 to 6.25. If you can carry that, then you have the hopes of rates coming down, which the trend has been a slow trickle down. I'll say that if you can carry that for 18 months to 2 years, you kind of have to tough it out. You can definitely take advantage of adjustable rate mortgages and do a 7-year term and save that 0.5%, put money back in your pocket. Totally a great strategy. If you anticipate, and most mortgage professionals do anticipate rates will trend down in the next 18 to 24 months, but we've been saying that for a while now.
Got it.
I personally think that it's a slow trend down, and I think we'll probably get back to the high 5% range, low 6% range, and that's a really healthy market. Like 5.75, 5.875 is pretty healthy. So if you're a first-time home buyer and you can kind of carry that higher interest rate, then that's fine. I mean, it's not fine, but you can do it. But also, let's understand what the higher interest rate really means. Sometimes it's only $200, $300 a month, and for some people, it's nothing. For some people, $300 a month, that's a lot of money, and we can't do this. And it really comes down to negotiating the purchase price of the house. Interest rates can only do so much. They're important, but they're not the most important thing. If you're in a bidding war and you're going $50,000, $75,000, $100,000, during COVID, we saw it, people were doing $150,000 over asking. If you're in that scenario, you're trapped in that price. That's what's killing your monthly more than 0.5% on your loan. 0.5% on your loan it matters. Don't get me wrong. But if you're overpaying, that you're locked into that purchase price.
What are some of the tips for locking in a good rate? And when should we not do it?
I'll tell you, again, in my practice, I'm a mortgage banker and a mortgage broker. When I do a loan, I have between 40 and 60 options that I look at on a screen, and I go with today, this is the best price, this is the best rate that I see. I only operate today because tomorrow, who knows what will be. And yesterday, I can't get that rate again. We're lucky right now in this moment in 2025 that rates are not fluctuating. there was a period of time where rates were jumping 0.25%, 0.5% per day, right? This is like post-COVID. Coming into 2022, they were jumping, and it mattered. Now you're seeing this leveling out of rates. So in my personal opinion, and I talk to the borrower, like what their opinion is. Personal opinion is, let's lock it, find the best rate today. And if things change in the future, we can try to address it in the future. But like, let's just lock it based on the last 3 months. It's been about, rates have been here. We're about here. If things change, we'll try to change with the times. I can't promise anything. I can't guarantee anything. And if the borrowers are good with that, that's what we do. But if the borrowers are these people who are like, you know what, let's risk it until the very end, we have to really talk that out. And I have to be really certain that they are okay with it. But again, so it really just a lot of times comes down to personal preference.
So I guess what are some of the signs that indicate a shift in the market? Are we able to watch out for those?
So in the rate market, you'll say most people will point to the Federal Reserve raising rates and lowering rates. The correlation between mortgage rates and the Federal Reserve is a little bit farther apart than the 10-year note and mortgage rates. So if you want to really track mortgage rates, you're going to look at the U.S. Treasuries. Yeah. Or the price of mortgage-backed securities. And those are better indicators than just the Federal Reserve and their comments. All those things are connected. They really are. Everything's connected, and as an economy is a web. Interest rates get very intricate very quickly. But for simplicity's sake, there's more correlation between the prices of mortgage-backed securities and interest rates. And that's an opposite relationship. So as mortgage-backed securities become more expensive, interest rates goes down, and vice versa. So if you're looking at the 10-year Treasury, that's a little bit more correlated to mortgage rates as well. 10-year Treasuries has been around 4.3%, but 10-year Treasuries has been around 4.3% for a number of months now. And that's why you've seen this stability in mortgages. Things have been in the middle to high 6% for 30-year fixed. As we're seeing trends in the market take place, Federal Reserve is making comments. We're seeing a slight trickle down from high 6 to middle 6. Is that going to make it break you when you're buying a house? Probably not. But it's nice. It's, at the end of the day, I always want my clients to have the lowest rate. It's your money, not mine. I'm not here to spend anyone's money. So keep all the money you can in your pocket. Why pay more?
Thank you. So next up, who should you trust with your mortgage? A broker, a bank, a friend of a friend? So if we could break down the key differences and red flags to watch out for.
Sure.
Yeah.
Broker or bank, I'm both. So I'm a mortgage-only bank. I don't have checking accounts. And then if I don't have something in-house that works, I broker out to the market to see if I can get that fit. Look, everyone has their own incentives. Who you should trust, you want someone who has demonstrated their proficiency, because at the end of the day, it doesn't matter what your rate is if you can't get to the closing table. At the end of the day, it doesn't matter how great your marketing is if I put $100,000 of your dollars at risk and don't close and the seller takes your money. So at the end of the day, the only thing that matters is closing on that property if you're buying. So I would, if I were to choose someone, I want someone who's been doing this for some time, right, some proficiency, and communicates with me. I want to hear from you. This is the biggest purchase of my life. I want to hear from you. I want to plan to hear from you.
But who has more flexibility, more options?
Who has the most flexibility? Mortgage bankers can go to different banks, but the ultimate decisions are based on the same rules, because you've got Freddie Mac and you've got Fannie Mae. Those are the ones setting the rules. They're very similar to each other. So if you've got just a traditional house, you've got traditional buyers, 2 buyers, nothing crazy going on, the rules are kind of the same.
Okay.
So it really comes down to someone, who do you trust, who has shown that they can execute, who has shown that they can get you to the closing table, and who do you hear from?
So how do brokers get paid? And
Sure.
what should you ask before you hire one?
Sure. Most brokers get paid a percentage of the loan, and they can either get paid upfront or it can be rolled into the closing costs. Pretty industry standard practice. What should you be asking is, again, how often do I hear from you? How many times have you done this before? How long have you been in business? Do they have positive reviews? And really set those expectations in line with your personality and their personality.
What are some of the red flags that we should watch out for when working with a broker?
Yeah, but that's a good question. The red flags to watch out for are the classic red flags of almost any transaction. Are they delivering you what they say? Do they show up on time? Do they get on a call on time? Do they say, oh, I'm going to get you this program, this rate, at this price, and then do they deliver a loan estimate that matches what they're saying? Markets change, things change, but are they living up to their expectations of what they're telling you? If they're not, it might not be a professional for you. Mortgage brokers aren't bad. Going to a bank isn't bad. It's really, again, about, do I have faith that this person can execute on what they say they're going to do in the time they say they're going to do it? And will they keep me informed to the level that I want to be informed at? That's reasonable. Sometimes people have unreasonable expectations. Will this person do what they say they're going to do, when they say they're going to do it, and tell me all along the way? If they're not a good fit.
What are some of the hidden fees to anticipate that no one expects?
Sure. So when doing a loan, there are no hidden fees. The hidden fees in a mortgage transaction are non-existent. Because of Dodd-Frank, you get a document called a loan estimate. Loan estimates are subject to change, but then you get a closing disclosure at least 3 calendar days before you close, so you know all of your fees going in. On the loan estimate, you'll know on or about what the bank is charging you, on or about what title insurance is going to cost, on or about what all these fees are going to be. So there really are no fees. There's no hidden fees. Hidden costs are people wasting your time, right? That's the biggest hidden cost. Things that people forget about, moving, painting, things like that. But in a mortgage itself, there's no hidden costs. And in fact, on a loan estimate, personal practice is to disclose more than what is typical. And that allows me to show you what you can expect and what, if I don't disclose something, I have to pay for it out of pocket. But I always show more, I'm always more conservative because I want people to be prepared for the closing table.
Now for the good stuff, the programs most people don't know exist.
Sure.
If you are a first-time buyer, a veteran, self-employed, or don't fit the traditional borrower mold, this is for you. Let's start off with the VA loans.
Sure.
Who would qualify for them and what's so great about them? And then maybe if you could touch on common misunderstandings.
Sure. So common misconceptions about the VA loan. VA loan is the Veterans Administration loan. That's what VA is. You got to be a veteran of the United States military. Whether you're active duty or reservist, less important, but you have to have served and you have to be living in the property and you have to be on the loan. So it's a very clear indicator that this is for people who sacrifice their time and bodies to serve our fine nation. It's for them. It's not like, oh, my dad was in the military, so I'm going to hop on a loan with him and I'm going to buy a condo in Miami, which sounds great. Like, I hope you buy the condo in Miami, but your dad's got to live with you and your dad's got to be on the loan and your dad's income has to be part of it. So it's a very specific, pretty rigid program. The good part is that you don't have to have a down payment. The bad part is that the VA, because they want to protect the veteran, the borrower, and their money, they're a little inflexible. So the house doesn't have to be perfect, and the FHA is like this too, but it has to be more safe than not. It has to be in good livable condition. There's certain nitpicky things, like if there's more than 3 stairs on a staircase, it has to have a railing and really getting into the nitty gritty. But the VA is for veterans and their families so they can live in a house. So the first-time buyer programs, we've discussed this a little bit, is usually what people mean when they say FHA. First-time buyer programs, whether it's FHA, Federal Housing Authority, or conventional, usually you're looking at low down payments, 3 to 3.5%. And a lot of times, depending on where you're buying, you can get something called down payment assistance. There are grants, there are 0% loans out there that exist in New York and New Jersey, where you can get, depending on where you're buying, you can get a portion of your closing costs or down payment assistance credited to you. Usually you have to live in that house for some period of time, 3, 5, 7 years, depends on the program. And it's really to help people get into homes. So that's a first-time home buyer program, so you're going to pay low down payment. Sometimes they'll get a discounted interest rate. That's semi-common knowledge and good marketing after 20-some-odd years. The cool thing that most people don't know is there's something called the Community Reinvestment Act. The federal government sets aside funds to give to local banks or banks in general to do something called a community reinvestment. So demographics are drawn up. I'm not in charge of any of this, by the way, where the government does their demographic data, and you as a buyer, if you meet the demographics or if you buy where the demographics allow for these community reinvestment programs, these loans can be more powerful or as powerful as an FHA loan, where you're putting down low down payments. Sometimes, depending on the program, there's either no or lower mortgage insurance, and you get a discount on the interest rate. Now, those are all great things, but you have to be a flexible buyer and buy where the demographics allow these programs to be implemented. So that's something that people don't know about. They should know about. Community Reinvestment Act, I love doing those loans. They're great. It's a wonderful, wonderful tool to get people into affordable housing.
Wow, thank you. Can you tell us a little more about unconventional loans?
Sure. So we wouldn't call them unconventional loans. I would call them non-QM or non-qualified mortgages. A qualified mortgage is, the traditional home buyer. They have their documentation for income, credit, assets, pretty straightforward, cut, dry, boom, no problem. Non-QM or non-qualified mortgages, that's where there's a little bit of hair on the deal. So your interest rate's a little bit higher, but your terms are a little bit more generous. So say you have someone who has a business and they've been in business for 12 months or 24 months. Sure, if they've been in business 24 months, they can go to a Freddie Mac or a Fannie Mae loan. I can do that all day long. But if they have a really good accountant, and accountants can be really good, the job of an accountant is to minimize tax liability in current year within the law. That doesn't work with mortgages, because what I do is I look at your tax returns. I look at your pay stubs. So if you're a business owner, and let's say, your business is thankfully really successful, but you have a really savvy accountant and you're putting money here in savings and you're deducting what you should be and can be deducting, and all of a sudden your great income goes to an average or below average, or if you have an accountant who gives you all the deductions you're legally eligible for, and you have a very successful business, on paper you make less money than you may actually make in real life. Those two things don't work in the mortgage business, because I can't say, hey, we got all these tax deductions and our income is low, but we want this high-end property. So now what am I supposed to do? I can look at the cash flow of your business with a non-qualified mortgage or a non-QM loan, and I can say, you're a business owner, you've owned a business for at least 12 months. I can look at your cash flow based on your bank statements, and now that's your income. So I can qualify you for more house based on the success of your business without penalizing you for taking advantage of the tax code.
Can self-employed people actually qualify?
100%, definitely. There's at least 2 or 3 ways for self-employed people to qualify for a loan for, again, I'm assuming, primary residence. Freddie Mac, Fannie Mae, as long as you've had a business in place for 2 years, you use the business income, you use your personal income, your business income. We look at all that, and we pre-approve you in the same way we would pre-approve someone who doesn't own their own business, and move forward. Just a normal loan like that. If you have...
It has to be the same business though, right?
So it's got to be a business that, if we're doing traditional financing for self-employed people, it's got to be a business that has produced income for 2 years.
The same business. You can't just hop from one business to the next. You had one business,
yeah,
and then you switched to another
as
business.
long as it's in the same industry, you can probably be okay with it. But if it's like, I don't know, restaurant for 6 months, and now I am a dentist for 6 months, and now I am a car mechanic, that's going to be a problem. As long as you don't go from car mechanic to dentistry, because then your hands are still dirty. So,
Okay.
but if you're saying like, oh, I have, let's say you, Yaffa, you're a media and you have a business that for whatever reason doesn't work out, partner leaves, but you're still doing media, and then now instead of Yaffa and Partner LLC, it's Yaffa LLC. Not easy, but not the worst.
Oh, really?
Yeah,
Even that
it's
would
a
be
little bit of a
problematic.
hiccup.
Interesting.
'Cause
Okay.
they really on a Freddie Mac and Fannie Mae loan, they really are like sticklers for 2 years. But if I can show, and this is where a professional loan officer comes in, if I can say, hey, look, she's in media for 10 years, she was doing business with a partner for 18 months. Partner left. This is the reason why. And now for the last 6, 7, 8 months, she's by herself doing the same thing, maybe even at the same address with the same client list with similar income. Then that's a story.
What about if you're self-employed and then you get a job in a big company? Can
It's-
you immediately
Immediately.
Wow.
It's so unfair. It's so
Really
unfair.
unfair.
I've had clients who make less money by going to a W-2 job, but have an easier time getting approved because they went from having multiple businesses and now they just got a job at one place and they make less money. They
But
make less
immediately,
money.
like soon
But
after.
Immediately.
Wow.
First
Okay.
you can be
This-
in contract on the first day of your job, as long as you get paid before we close, it's fine. It's very strange.
Yeah. Okay, time to bust some myths.
Let's do it.
I'm going to throw out a common mortgage belief, and you tell me true or false. True or false, you need 20% down to buy a home.
False. But also it depends.
Okay. True or false, the interest rate is the most important factor.
False. It is important, but the purchase price is the most important thing.
True or false, a 30-year mortgage is always better.
False. There's no such thing as always. It depends on who you are.
I like that. True or false, your bank is the safest bet.
Mortgages are safe to do in the United States based on legislation that we have in place. Find someone you trust.
Great, thank you.
Thanks.
This rapid fire made me sweat here. All right, so before we wrap up, I wanted to ask you, what's one piece of advice you wish every home buyer knew before signing that dotted line?
Try not to get your emotions too involved. Rate is important. It really, truly is. But the purchase price is the most important thing. Are you getting a fair price? That's what you want to focus on as a first-time home buyer. Rates change. They go up, they go down. You can refinance. Refinancing does cost money, but you can always change your rate in the future. You can always pay more towards the principal to lower the amount of interest you pay. You can never change the price you paid for the property. So when you're working with your real estate broker as a buyer's agent, make sure that they're negotiating the best and most fair price for you. People think buying a home is rigid. It's not. There's so much flexibility. You can buy a home today. You can sell it in 2 months. You're not stuck. It's going to be okay. If things get bad, we'll figure out a solution.
That made me breathe better, too. Ooh, okay. Joshua, thank you so much for being here today.
Thank you so much.
How can our viewers find you?
Great question. FM Home Loans is my company, fmm.com/Joshua Brenner. Joshua Brenner on Instagram. I'm only a phone call or a DM or an email away.
Thank you. And if you're new here, don't forget to hit subscribe. Thanks for listening, and catch you next time. Thank you so much for being here.
Thanks, Yaffa. Do you want to do that?